Good morning, and thank you all for coming to our first Business Owner Summit. We really appreciate you guys spending Friday with us at the beautiful Four Roots campus. During lunch, somebody from Four Roots is going to talk to you a little bit about the farm and what they do. Instead of doing a stuffy ballroom, we decided to pick a awesome event space like this. Jason and his wife, Carol, are on their foundation board and donors, and I think it's a hidden gem in Orlando that a lot of people don't know about. So I'm sure you would rather be here than in a stuffy ballroom. So there's three of us that are going to speak today. Myself, my name is Carrie Sobel. I am the Chief Acquisition Officer at Coastal Investment Company. I'm joined by my colleague, Rich Hayes, who is an advisor and tax strategist at Coastal, and a dear friend of mine, Jason Hendren, who is the CEO of Hendren Business Advisors. So Jason's presentation is our keynote. It's Skip Your First Exit. I've sat through the presentation. It's awesome. Jason tells his story and a lot about private equity, and he does a really good job simplifying some of the concepts about private equity into bite-sized nuggets that are a little bit more digestible. He also wrote a book, The Things I Wish I Knew Before I Sold to Private Equity. Everybody in this room probably owns a business or knows somebody that does. It does a really good job, again, of just translating some of the dynamics that exist in the private equity space so that you can relate it to your business. I encourage you guys to read it. Lunch is going to be sponsored by Coastal Investment Company. I will bother you guys a little bit during lunch and tell you about the company. And then Rich is going to come up and teach you how to save money on tax. So we know everybody here doesn't like paying taxes. He should be able to help out a little bit there. And it was important to us that everybody leaves today with at least a nugget that you can take for your business of something you can immediately do to make an impact on your business. So we'll end with that. So the concept of the Business Owner Summit is something that started a long time ago. Jason and I have been friends for about a decade, and we were around the UCF community. I'm an M&A advisor and business broker, and Jason is an exit planning advisor. And we're both former entrepreneurs that enjoy just the camaraderie of business ownership together. And there was a common theme in every conversation that we had is that most people that own a business don't ever think about exit planning or exit strategy. Exit planning is actually business strategy. It's not what you just think about when you want to exit. So first question for all the business owners here, raise your hand if you have a business plan. Raise your hand if you started your business with a business plan. Raise your hand if you had an exit strategy as a part of your business plan. Anything about exiting. And you know, it's funny, I took a class at UCF, and it's probably one of two I remember in my 4-year tenure. It was Business Plan Prep. It was by Dr. Cameron Ford, and he actually told you that you're supposed to have an exit strategy as a chapter in your business plan. And the fact is, most people don't start their business with the end in mind. Now, it's not going to happen most of the time, but you are supposed to start thinking about exit strategy well before you want to do it. Up on the screen is what I call the founder's dilemma. These are all successful exit strategies, and there's more that exist that are not up on this screen. 80% of the businesses that actually get listed for sale never sell. It's mostly because they're overpriced and expectations aren't aligned, but unfortunately, most people never evaluate any of these, learn about any of these, and today we're going to teach you about some of them. But it's something I encourage all of you to do is talk to an exit planning advisor, start evaluating what opportunities you have in your business to eventually have a successful outcome. We are going to move right on to Skip Your First Exit, which is our keynote presentation by Mr. Hendren.
Hey, everybody. Woo. Let's go. All right, so a little bit of history about this. I have been doing talks for Vistage. Who knows about Vistage Groups? CEO peer group organization. I've been doing Vistage talks for years now. And this is my Vistage talk, or at least the first 2/3 of it. And I have been going around doing this, you know, all around Florida, mostly, because I won't travel and leave the state. And the reason that we wanted to do today, when Carrie and I started talking about it, is I would love to bring my Vistage content to all of my friends. I have so many friends that own businesses, and I'm like, man, I get all these great feedback from these business owners that are in all these groups. I want to do this for my friends. And what's weird about this is I'm not used to talking to a group that has so many of my friends in it. So this is a little weird for me. But thank you all for coming. Thank you for making the time. I hope you love the venue. I find it very peaceful here. So here's a little bit about me. This was the best day of me owning my business. That fella staring at me longingly is now Senator Rick Scott. Back then he was Governor Rick Scott. And we did what was called a jobs announcement at my company. It was called Industrial Lighting Products. It was up in Sanford, Florida. We were growing like a weed, expanding, and the local business development folks were like, hey, Governor Scott's coming to town. Would you like to host him at your factory? And I will say, I don't care what your political affiliation is. If the governor wants to come to your business, open arms, welcome the governor. This was the best day. We had all of the news crews there. Our colors were royal blue and white, and all the ladies who worked in our management all wore royal blue dresses. There's a picture of like 20 of them. I didn't even know they were doing it. What was great was when this was kind of all over, we approached the cameras, and Governor Scott was fluent in Spanish, and he gave a whole address to Univision in Spanish and asked me if there was anything I'd like to say, and I pieced something together in Spanish, and he just started laughing. He's like, anything you want to say in English? And then he stayed and talked to every single person on our floor. So I had this business. We started it in 2002. I had 3 people that were in the lighting industry who wanted to start another business, asked me if I wanted to be their 25% partner and be their operator. I said, well, you know, it's a big leap. Should I do it? And my wife's like, listen, I have our benefits, and if worse comes to worse, I make enough money. She was in pharma. She's like, I have a company car and I can pay our bills. We can get by until you figure something out. So I took the leap. So 2002, go, very, very like beginning of nothing. From 2002 to 2008, the great financial crisis, we grew. And we were up to about $7 million a year in revenue when my partners said, hey, our other business that's also in lighting is an ESOP. We have to get out. Like, what do you mean you have to get out? Like, well, either you buy us out, we're going to find someone to buy your shares. When I tell people I'm the reluctant entrepreneur, I'm not kidding. I was terrified. I remember going to the closing with my wife, like trembling, and she's like, is this actually going to happen? I'm like, if they show up, it's going to happen. Because the night before, they tried to get me to sign a personal guarantee on the money that they were loaning me, even though I signed a personal guarantee on the money they were getting from the bank. It was absolutely terrifying. So 2008 comes, we get this deal closed. Beginning of 2009, I own the business 100% by myself with a couple $1 million of debt. We grow, get to about 2010, 2011, all the debt's paid off from the acquisition. I got no debt, no partners. Company's making a couple $100,000 a month. It's good to be Jason at this point. Life is good. Chris was there. And then the phone starts ringing. I had no idea who was on the other end. Private equity groups, investors, investment bankers, all these folks who were on my back saying, hey, do you want to sell your business? You know, have you thought about doing an exit? You know, what's your future plans? And I'm like, completely undergunned. I have no idea what's going on. I bring in somebody who kind of does what I do today to kind of Sherpa me through the process, and I did my first exit in 2012. 2012, our profit's about $3 million a year. I bring in a private equity group. They say, hey, we want to be your partner. We want to buy the majority of your shares, be your partner. And I'm like, well, all that partner stuff sounds good and all your future plans sound good. How much am I going to get? Because I knew I was giving up my cash cow. It had to be enough. And what we got in that moment was what we felt like was life-changing money. So I go forward. Now I've got this private equity partner. I'm the CEO, go. They had this whole business plan developed. And for the next 4 years, we grew our earnings from $3 million a year to $10 million a year without buying another company. When we get to the end of it, we exit the company. It was an incredible outcome. And a lot of what we're going to talk about today are those lessons that I learned from when I was an independent operator and the million mistakes that I made then, when I became the head of a professionally run organization, and then did an exit and stayed on with that group and actually started doing some of that M&A, because we looked at a lot of companies and we ended up buying a couple. So most business owners, this is you. Your largest asset is your business, and then everything else kind of fills in around it. So what I recommend for anybody who's a business owner that's kind of building their business and you're head down and you're grinding, you're making things happen, first thing is do a personal balance sheet. Go in and write down every one of the assets, including your home and including your business. And write down where am I at with that and update it every 6 months. And look at it. Is the value of my business growing? You know that by tracking what your trailing 12 months earning is and putting a number on it, a multiple. You know what your house is worth. Update it every 4 or 5 years. Look at your stocks. Look at your real estate. Maybe you own your facility. Look at your note. And look at that number and watch it and make sure it's growing. But if you're like most business owners and this is your asset allocation as a business owner, I want you to start thinking about that big piece there, your business, as an asset. If you owned a piece of commercial real estate, you would look at that piece of commercial real estate and you would want to every year have escalations on your lease. Anybody who's renting from you, every year they get an escalation. They go to renewal, you get an escalation. Why? Because it's supposed to grow over time. Your business is no different. I was so focused on growing and buying equipment and everything else, I wasn't looking at the details of my business, which actually hurt me when I did my first exit. Now, I didn't do bad, but I certainly left a lot of money on the table. So what I'd like to do is encourage everybody to have an asset-based mentality. If you own a business, I want you to think about your business as an asset. Not an income-producing machine, but as an asset. Your business is an asset. It's a great income-producing machine, but you have a host of clients as an accountant, and that host of clients is an asset that you can monetize at some point in time in the future. Lisa, your business is no different. You go around the room, your business is no different. Yes, your business produces income for you, but at the end of the day, that business is an asset. And only one of 3 things are going to happen with that asset. You're either going to sell it, you're going to fail, or you're going to die with it. If you could come up with something else, please let me know. But most people don't think about it that way, and when they start to think about when the right time to exit the business is, you missed your window. You missed your window because you're too old. You missed your window because the business industry isn't value anymore. You missed your window because you stopped growing. The minute you start shrinking, that business isn't worth too much. And when you're not thoughtful about the exit process, you end up having one of the 5 Ds. This is why businesses usually sell and why most owners are profoundly regretting their exit. Death, disability. I knew somebody, his whole job was on the phone. Had an issue that attacked his larynx, couldn't talk on the phone anymore, disability, can't work. Sorry. Divorce. Nobody likes that one. Partner disagreement. You know, when you have multiple partners, if the partners can't come to a conclusion sometimes, that'll break up a business and force a sale. We've certainly seen a lot of that. And the last thing is distress. Your balance sheet gets upside down. Anybody who's worked with me, and I've worked with several businesses in here, I am a hawk on the balance sheet. I never want the debt and the obligations to overrun the business's ability to generate cash. So what I want you guys to think about is, I have a business. This business should be an asset that I should be able to monetize at some point in time in the future, and I want you to start treating it as such. And the whole concept here is this. If a private equity group bought your business, they're buying your business to grow it and monetize it, and they're going to make a significant return in doing it. I want you to do the things that they would do with your business and do them now at your business. So instead of getting that valuation that I got when I did my first exit, get the valuation that came 4 years later that was 7 times the value that I got when I first did it. Do all those things now. So to do that, we're going to start talking about how does private equity create wealth? What do? How do they buy your business, do a bunch of stuff to it, and then exit it later? And I'm going to try to convince you today to do these things yourself. So let's start off with the basics of private equity. So does anybody here understand the difference between financial buyers and strategic buyers? David, go for it. What do you got?
A strategic buyer is someone who's going to integrate that into their operation, and financial buyers that buy your cash flow.
So a financial buyer is somebody who's making their first investment in a space. I'm a guy who's got a pot of money. I want to be an investor. I'm David, post my first exit. I come over and I'm thinking, man, I would love to own a promotional products company. I'm going to go to Byron and Trade, say, hey, I want to be in the promotional products business. I want to create a structure where I can own your business, and now I'm in that business. Great. That's a financial buyer. Strategic buyer would be somebody who's already in the promotional product space. They're out there doing, $100 million a year of EBITDA, and they love the niche that they're in their customer base, and they're going to come in as a strategic buyer and buy them. I don't care what business you're in, your vendors, your competitors, or your customers are all involved in this loop right now at some level. Because private equity is pervasive, buying and consolidating businesses. So when you think about it, there are people out there who are buying that first acquisition, and then there are people out there that are in the business and making a second acquisition. You guys could say, hey, we're in the Porsche business, we want to be a strategic buyer. Maybe there's a shop on the west side of town that we can go ahead and pick up and expand our footprint. We laugh, but that would be a strategic acquisition. That's exactly what it would be. You could use a combination of your cash and bank debt to go out and buy this business, and now your business is bigger. And now you could do what are called synergies. Synergies are where we call it 1 and 1 equals 3. I'm going to take the aspects of your business, I'm going to take this other business, and I'm going to consolidate purchasing, accounts payable, and human resources. Because I don't need to have that for both businesses. I already have it on the bigger business. I'm not going to have it at the smaller business. I'm just going to bring it in mine. Now all of a sudden, if they're making $1 million a year and you're making $1 million a year, together you may be making 2.3. All of a sudden that acquisition's making a whole lot of sense. And most companies in here all have the ability to do that at some level. Simon and Rebecca have a shop with 10, 11 employees at this point. You could absolutely do this at a business of that scale. You guys have how many employees? You guys could do the same thing. You guys could be looking out there and saying, what other businesses exist and how can I do this strategic add-on to increase the value of my business? But if you're on the companies being purchased, if you're the target, not the acquirer, I want you to think about this because there are some very important differences here. If you are being acquired as by a financial buyer, means you're your first acquisition in the space. One, they're counting on your leadership. If you're the CEO, they're counting on you. Or maybe they're going to bring somebody in. Maybe that's a conversation you have. But for the most part, your management team will be intact. They're going to be expected to now work within this private equity empire and grow and do acquisitions because that's kind of part of the basic playbook. Your equity, when reinvested, is going to go onto a clean balance sheet. There's no existing equity. There's no weird valuation of how your shares are coming on. The valuation of the company is going to be based on however that initial valuation is set up. Conversely, if you're the add-on acquisition, the reverse of all that happens. Giant marketing agency out there wants to buy your business, bring you on, say, hey, Frank, we want you to be a partner. We want to do X, Y, and Z. Well, great. Well, if you have a controller, an HR person, some strategic leaders in your business, those people may not be long for the world based on how their synergy strategy is, and they may not tell you. The other thing is you may not have a job. But sometimes being acquired by a strategic acquirer is good because you don't want a job. Maybe you just want to retire. And if that's the case, that's fine. I've been involved in plenty of exits where the owner says, hey, listen, I want to go away. And a strategic acquirer is the best way to do it. You work out a 2-year transition plan, and everybody knows what's going on the day of the acquisition. But if they want you to reinvest, you're reinvesting into an existing cap table, which means that they are valuing the shares that your reinvestment is going to go into. And I've seen these shenanigans more than once. If I own a company that is just been purchased or trading around 8x, but I think I'm going to sell it at 10x, I value my balance sheet at 10x and roll your shares into it at 10x, the multiple. It's all a way of saying that they can sometimes use inflated shares to repurchase yours, and you basically sold those in as a discount. Kerry's nodding his head. You have to see this all the time on the business brokerage side. But the biggest piece of this that I want you to take away is whether it's a strategic buyer or a financial buyer, more often than not, behind it, there's a private equity group. And in this country, there are thousands of private equity groups, and they have billions of dollars, trillions of dollars in dry powder that are actively committed to them to invest. I personally am an investor in a private equity group in Chicago that bought me in 2012. I'm a GP in their general partner in their 4th fund and their 5th fund. Now, private investors don't typically have access to those, but this group in particular allows their former founders to invest in their platform, so when they go out and fundraise to the institutional guys, they can go out and say, this is how many of our former founders invest in us, they believe in what we do. And they're good at what they do. But basically, these private equity groups are pervasive, they're everywhere, and they're putting money to work. And they've been doing it since the 90s. Couple things changed back then. First of all, that's when banks started lending against business. It didn't used to be that a leveraged buyout was a thing. It became a thing, where I could go to the bank and say, hey, I want to buy this business for $100 million. I'll put up $50 million of my money. Will you loan me the other 50? It used to be that didn't happen. Banks started lending on that. Over time, there became a lot of regulations in taking companies public. It used to be you could take a small company public, and that was a good way to monetize your shares, raise money, and give you a path to liquidity. Well, it got really hard to do that. Today, you have to be like $500,000 or $500 million in revenue to even think about really doing an IPO. So it created this space for private equity. And what's happened in private equity is the pioneers of it that were doing it in the 90s spawned off all these people who understood the game. You get leverage, you do add-on acquisitions, you do all these other things, you create enterprise value, and it's created a lot of competition. It means that for all these small businesses, there's a lot of people out there that are interested in buying them because there's a lot of people who understand how to do this. It's helped with multiples as a seller. It's also meant that they've been finding new places to go. So right now, they're starting to get into different areas that they used to not get into. Like healthcare 10 years ago really wasn't a big private equity target. It is today. Because the traditional businesses, the moms and pops, the retail and all that stuff, it's all kind of been done. And now that private equity is going out to more and more corners of industry and trying to find a way to take a fragmented industry, consolidate it, then sell it to a bigger player, a large fund, or take the companies public. So I want to describe to you kind of how carried interest works. Who's familiar with this term, carried interest? Yeah, I know you are. Byron probably is too. So carried interest is essentially the way private equity groups make money. And what's interesting about it, it gets unique tax treatment. But I want you to understand this model because the way this model works is what's going on behind the scenes with the money that's being invested in all of these companies that are out there trying to acquire businesses like yours. So it starts off with investors. Now the investor could be me as an individual. The investor could be somebody who goes to Coastal and says, hey, you know, we're raising a $50 million fund. Can you guys raise a $50 million fund for us? Maybe the private equity group is going out to institutional guys. It could be hedge funds, retirement funds, the city of New York pension. They go out there, they raise this money, and they get it from LPs, limited partners. Limited because you don't have a whole lot of say in things. You're signing up for a document that says how this is all going to work, and away you go. Then that money goes into the private equity fund. Private equity funds raise the money, and typically they're doing it one of two ways. They either take all the money up front, or they do it in cap calls as they need it, they call it in. The fund that I actively invest in, they do it in cap calls. Then they go out and they buy companies. They're buying the companies, they're getting a management fee, they're getting a portfolio of companies, they're getting 1, 2, 3, 4, 5, 6 companies, 14, 15, depending on how it is, and those companies are going to be within a stated range in certain industries that kind of fit the niche that they think they're good at. Then they're going to sprinkle in their private equity magic. And the private equity magic is how they take those companies, sell them, and create proceeds. And when they do that, they split the money so long as certain hurdles are met. A basic hurdle could be, if you're an investor, so long as I give you a 10% return on your money, we split everything 80-20, as long as I meet your minimum return threshold. Now, private equity companies don't operate on those minimum return thresholds. What they really need to do is beat the returns of the public markets. Because if I can go to the S&P and I can get an 18% return, I need these guys to do 22 for me to have it make sense because it's illiquid. So these guys are out here, they're trying to make 20, 22, 23, 25% returns for you as investors, because if they don't, they're not going to be able to raise their next fund. So when they do that, they make their money, they meet the return thresholds, they share it between the partners, limited partners, and the general partners. The general partners are the people who sit at the top of the pyramid at the firm, and there's a waterfall for how those funds are shared down among the folks. And for those folks at the fund, they actually get treatment not as if it was a bonus that they received through ordinary income. It gets shared with them at cap gains rates, which is very beneficial. And every time there's a tax law, you'll hear about the carried interest or the private equity loophole. This is what they're talking about. So as all of this is going on, they've got that private equity magic. What are they doing? What are they doing to buy those businesses and make them more valuable? And what we're going to do is we're going to walk through an example of exactly what they're doing. And again, for many of you in here who have operating businesses, I want to convince you you can do this yourself. The things we're going to talk about here are all things that you can do in your businesses. So we're starting off with a $15 million annual revenue business that's making a 35% gross margin, a 15% net margin, and growing at 10% a year. So private equity bought this business for 5 times its value, which is what many of you, if you were to go out and do a direct sale right now of a company of this size, you'd probably get about 5 times for it. You meet someone at an event, just like I did, life-changing money. Would you be willing to consider this? Oh my God, next thing you know, deal's closed, and here I am. So how is private equity going to make money on this transaction? Well, the first thing they're going to do is they bought it from you at 5, they're going to sell it at 7. Now that sounds easy, right? They're just going to buy it at 5 and sell it at 7. Well, how are they going to do it? So we're going to take this exact same business, and throughout this entire exercise, we're never going to touch the growth rate. The first thing you can do to make a business more valuable is make it grow faster. But I'm going to show you how they make money without ever touching the growth rate of this business. First thing they're going to do is they're going to improve the exit multiple. They're going to do that by having a CEO sitting in the chair of the business that's been there for multiple years and is ready to serve the next owner or go home at their will. It's not going to be an aging owner who's going to take an 8-figure check and go home, because that creates what they call CEO risk. They're going to be like, hey, I'm going to give this guy a big check. I'm counting on him running the business going forward. They're going to take that out of play. They're going to put somebody in that seat when they sell the business that's ready to do it. When I did my first private equity exit in 2012, where did the years go? They said to me, after 2 years, we'll have a conversation on where you want to be. And after 2 years, they said, okay, Jason, we're about 2 years away from exiting. We either need to transition the CEO role now, or you need to be prepared to stay in the seat. And if you stay in the seat, here's what you're signing up for. You're going to reinvest equity, and you're going to be making a multi-year commitment to those folks who are going to buy the business. And you have to be prepared to not only say you're going to do it, but actually do it. And I was young enough. I was 43, 44 at the time. I was right in the prime of my career, sure. And I thought my calculus was the company will be worth more if I'm sitting at the helm in 2 years when it goes to sell it. So I signed up for that. But they were doing that calculus on the exit of my CEO is important. My CFO is important. When you sell that business as a private owner, you've got your controller who's probably been there for a while. Maybe you have a fractional. A private equity seller is going to have somebody in there that knows how to manage leverage in a deal, knows how to deal with bank covenants, and really has a pulse on the financials of the company, not only the basic stuff, but the complex stuff as well. So when they go through and they sell this company, they're going to run a complex auction process. They're going to hire an investment banker that understands their industry, understands the value triggers, understands what's going on, structures of deals, and they're going to market this business to a wide range of strategic and financial buyers to make sure that they're getting top multiple for it. They're not just going to take that one meeting and say, oh, okay, yeah, let's structure something. If I get $10 million, I'll do the deal. That's what I did. I didn't run a complex auction. But they're going to do that. So when they do this, over a 7-year span, they're making 21.8% return on their money. Not a bad return. Better than a market return. Some of the coastal guys would tell me that, there's probably things out there that you can get that return. But in a general stance, a 21.8% return is pretty darn good, but they're not done yet. Next thing that they're going to do is they're going to improve the margins for you guys with product businesses, manufacturing, any of the types of service businesses. This is what I call picking up the pennies on the floor. So they're going to strategically look at the aspects of their business and say, I'm going to move my gross margin and my net margin by 0.5% a year. These are not monumental leaps. I'm going to just move it just a little bit. Maybe I'm going to do it through a purchasing initiative. Maybe I'm going to go to my largest vendors and look for a price break or maybe a rebate. I'm going to go out and say, hey, should I outsource my HR? Should I insource my HR? I'm going to look at my pricing schemes. You can usually bump your pricing by 0.5 point. So I'm going to look at this and say, I'm going to move these two things 0.5 point a year. And over 7 years, how's this going to look? Well, now our 21% return went up to a 25% return by making these little, small moves in your business. This is all planning. This is all strategic planning. This is all looking at how you price your projects, looking at your infrastructure, and every year when you start your year saying, how am I going to do it this year? That planning starts in October or November, and then you look at it and say, what am I going to do to move it this much? Yes, I want to grow the top line, and in this example, we're growing 10% a year. This is not a fast-growing business. But what am I going to do to eke out just a little bit more? And that's the impact that that has. I always think of business as like a barge. If I'm leaving New York and I'm trying to get to Florida and I have a 1 degree miss in the trajectory that I'm taking, by the time I get to Florida, it's going to be way off. Businesses are the same way. You can't say, oh, I'm going to sell the business. It's time to start installing these types of programs, focusing on my margins, focusing on my management plan. It's too late. And that's why we say that people miss their windows. We want to start doing this now. I encourage everybody in this room, have a planning process at the beginning of the year. Think about your margins. Think about what you're going to do to expand them. Not only your growth, but how am I going to be operationally efficient and make these small changes over time that at the end, when you go to sell this business, you're in a much better position. So now we're going to talk about adding debt to the business. And this is where the strategic acquirer adds debt to the acquisition. So instead of writing that check for $11 million to buy this business, they're going to borrow some of that money from the bank. And this is a strategy you might use if you were to buy an add-on business. So you go to the bank, you go to somewhere and you say, hey, I'm going to buy the business. So we're going to buy a very, very small, and in this one we're going to add debt to the acquisition of 2 times EBITDA. So just generally speaking, when we talk about debt and acquisitions, it's always a multiple of the earnings. And in this case, it's very, very, very conservative. I promise you, when I talk about these returns, I am not pulling these levers hard. This is as conservative as it comes. So instead of doing all 11.25 in cash, we're going to do part of it in debt. And by doing it in debt, we've invested less capital, but we have this debt to pay off. But what does it do to your overall return on your money? Now you're up to 32.7. So if you guys wanted to go out and buy a staffing company in another market, and you wanted to think about how would I buy that company coming out of pocket, if you have a clean balance sheet, you can go to your bank and get the money to do it. And in this case, that's what they did. They went out, they used the leverage on the acquisition, and they were able to do that. So now your return's up to a 32.7%, but they're not done yet. Next thing they're going to do is an add-on acquisition. So now here's a platform investment owned by a private equity firm. They went out, they bought Cavallero. Cavallero is their platform acquisition. They own the company, and now they're going to go buy a small staffing company, maybe in medical. As you think about how you can grow, right? You can grow by buying competitors, so expanding your market share. You can grow by purchasing geography. You could grow by buying a different specialty. You could grow by buying upmarket, who are the people that I'm a customer to, buy them. Or you could buy the people that are customers to me, go down market. So vertical integration and expansion. So this group's going to go out, they do trophies, and their strategic acquisition is going to be Acme Ribbon. So they're going to go out, they're going to purchase Acme Ribbon. How are they going to do it? They're going to go, it's a $3 million business value, only doing $1 million of earnings a year, and they're going to do it all debt. Why? Because the company's doing good, and as our friends from Valley Bank know, that companies that are doing good and have clean balance sheets, you are all too eager to lend them money. Right? That's just how it works. You have a good customer. They want growth capital that's safe with an existing entity in an industry you believe, with a management team you believe in. All too happy to loan the money. So now here we're going. We bought this company. We're going through. Here's the example. Now they're up to a 36% annual return. Virtually everything we talked about here you could do in your businesses. But this is how private equity is going to get a 35% return on their capital. And I would argue that most of you guys can do these similar things if you want to strategically grow your business and think about not just, hey, this is a cash flow machine for me, but it is an asset. It's an asset that I'm going to nurture as if it was a piece of real estate. So as we think about this timeline horizon, you see the returns went up, but the gross dollar values went down. The dollar values went down was because they invested less money. What did they do with that other $4.5 million that they didn't invest as we added leverage to this purchase? They bought another company, they diversified their portfolio, and instead of having a trophy company, they had a fishing reel company down the street. But this is how it works. This is how the program comes together for private equity buyers to create wealth. And they're doing this pervasively amongst all industries. And for most of the businesses in here, there is somebody out there that has an investment thesis about your industry, whether it's boating equipment, staffing, mechanics, definitely engineering. My God, Dale, there's so much engineering money out there right now. People consolidating engineering practices. Manufacturing products company, I mean, it's all out there. These types of businesses are all being acquired by private equity because these are good businesses. They're in huge industries, big addressable market, and fragmented. Means that there's lots of small players. So I want to talk to you guys about kind of how we think about the value of the companies when we exit. Has everybody heard this term? EBITDA. Say it with me. EBITDA. Say it again. EBITDA. If you ever get into doing an exit, you're going to hear this word over and over and over again. And then you're going to meet some guy from New York who's going to call it EBITDA because they're fancy and they work in finance. They don't actually work in finance. Panapinto's laughing because you know that's how it goes. Earnings before interest, taxes, depreciation, and amortization. Why is this important? Because what we're doing is we're backing out the interest from your earnings because your debt, the new buyers aren't taking with them, which means they're not going to take your interest obligations either. So the interest is going to go away. Taxes, they're going to have a completely different tax structure than you. Your taxes aren't important to them. Depreciation, they're not taking your depreciation schedule. They're going to do a combination of an asset equity deal. They're going to reset the depreciation schedules. Your depreciation isn't important to them. And amortization, same exact thing. What we're doing is we're getting down to this business's core ability to generate cash. Because in a leveraged buyout, what's important? How much cash is the business generating, and then how many times on a multiple of that cash can I lever this deal to make the acquisition? That's what's going to drive my returns. What number is more important than EBITDA? Kaz, what number is more important than EBITDA? Piercy, I should have known. Yes, it's adjusted EBITDA. Say it loud. Adjusted EBITDA. You know what adjusted EBITDA is? Adjusted EBITDA is when we add back all those benefits that we take as owners. Add backs. Very important. You want to know what my biggest one was? Completely overlooked it. Was recycling. So I have 250 employees in Sanford, Florida. I have this giant metal shop that runs 24 hours a day, 6 days a week, and we produce so much scrap metal. The scrap metal would go in the steel bin and the aluminum bin. Once a week, the guy would pick it up. When he picked it up, he would hand me an envelope for what he picked up the week before. My wallet always looked like a Bible. Just stacks of hundreds, all off book. So what happens is that a guy comes in, and this is how it always goes. Hey, Drew, love your business. Tell me about it. Oh, great, man, you're in that industry. How much you make in a year? $3 million. Oh, do my little quick multiple. Would you take $15 million for your business? Maybe reinvest a couple $1 million, and you're thinking, this guy's about to give me $11 million. And the minute your eyes got big, you lost. Because when he asked you what your business was making, you said it was about this. That's what I did. I'm making about $3 million a year. No. The right answer is my adjusted EBITDA is $3.7 million and I'm growing at a 10% compound annual growth rate. Know your adjusted EBITDA. Know your adjustments. Know what your business is actually making. If you're writing off your boat, your plane, your fancy Porsche, if you're writing off any type of, you're paying your kid a salary, you're paying your wife a salary that's not working as hard as you are. If you're in here and you're running expenses through your business, which the tax code gives us to do, I want you to know that you can back those things out and they will be backed off in a valuation. So the way this typically goes is I go to Dale and I say, Dale, I want to buy your engineering company. You say, okay, great, I'd love to sell my engineering company. How much is your engineering company making? And you say $3 million. I say, great, $3 million, it's probably worth $15 million. Great, we're going to buy Dale's engineering company. Away we go. They're going to say, sign an NDA, give me your financials. This is what they're going to do. They're going to calculate your adjusted EBITDA. If your adjusted EBITDA comes out to 3.5 million, they are not increasing their price. They've already saw your eyes get big, you lost. But if your adjusted EBITDA goes lower, they're coming back for a haircut. And they're going to show you all the reasons that your financials don't actually support the number you thought. At all times, I don't care where you are in your business life cycle, if you ever sit down in that conversation, you are going to be undergunned for that conversation because the other person on the other side of that is a professional purchaser of business and you are a professional operator of your business. This is what they do every single day. You operate your business every day. It's called information asymmetry. It always exists. So the way to start breaking down the information asymmetry is first, be a disciple to your numbers. Know these things. Know your adjusted EBITDA. And the second thing is never go into one of those conversations thinking it's a casual conversation. They're never casual. They're there to make a friend, get you to trust them, spill your beans. Oh, I really want to stop work and I need to go take care of my sick mother. Whatever it is. You got to go do something else that you weren't doing before. But I want you to be prepared for these conversations because this is what it all comes down to, adjusted EBITDA. And I promise you, they're calculating this behind the scenes. And if it's higher, they're not going to tell you. And if it's lower, they're going to throw it at you immediately and give you a haircut. So, and valuations. How many people in here have gotten a valuation done on their business? Did you think it was good? Would you think it was worth the money? No? You know why? Was it worth it? You know what a valuation is?
It was worth it, yeah, because it was during a divorce. I had to.
Oh, yeah.
So
well.
It worked in my favor.
Okay, well.
Her valuation was different than mine, obviously, but there was some
Okay.
goodwill associated with it.
Okay, well, I'm not going to get into the nuance of your divorce, other than to say this. If you are a small and medium-sized business, which we all are here, more often than not, your valuation falls somewhere on this heat map. And the reason why is simple. A, the businesses that you're being compared to when they run a business valuation, the comps, are all private market transactions. It's never public information. If you guys were to sell Cavalier tomorrow and hire an investment banker, they're not publishing the value of the acquisition. They don't publish that stuff, even at a business your size. They don't publish it. My business, my last transaction was $100 million. Nobody ever saw what the actual final terms of that deal are. So for comps, they don't know what they're doing. Then they're going to rely on a discounted cash flow model. But in the end, the multiple's going to fall somewhere in here. If you're sub $5 million in EBITDA, you're too small to be a platform acquisition. You're going to get add-on money. Add-on money is small, depressed, low single digits. That's just what it is. You start to get up over $5 million, now you're in platform land. Means that somebody could buy you as the first investment and then build off of you. And then as you go up, you can go up this scale. When I sold my business last time, we were in the 10 by 10 range, and we had a good exit. Do you know where these exits terminate? Public market valuations. When I talk to home builders, I tell them public market valuations, and every guy in the room opens up their room to see what the PE ratio of Toll Brothers is, which is like 7 or 8. Which means you, as a small business, aren't getting anywhere near 7 or 8 because that's what a public company's getting. Public market valuations are the highest because they're liquid, and it's very, very transparent and highly regulated. So if the biggest company in your industry is getting 12 times, you're probably 7 or 8. Because when they exit that business, they're still not going to get 12 times, right? So that's kind of how these economics work. But a valuation is only one thing. It's the number that someone is willing to write you a check for at the moment they're willing to write you a check. That number isn't good a moment before, and it's certainly not worth it a moment after. Because if you are in the due diligence process and everybody's agreed upon a valuation and there's some black swan event that affects your industry, your valuation's gone, you didn't do anything wrong. But it happens. So when you're thinking about this in valuation terms, if you're growing like crazy, your valuation's good. The minute you stop growing, the valuation went away. We can kind of think about what our valuation is, but all those dynamics are really market and independently affected by different things, whether it's the health of the owner, whether it's a big client with customer concentration. Any of these things affect your valuation. So when you're thinking about this, I want you to always realize that even though you might think what your valuation is, that number is very temperamental, and it's hard to get that buyer at the table to write that check. But for valuing your personal financial statement and doing your own personal balance sheet, pick a number and stick with that number. And if your adjusted EBITDA is 2 and you want to use 4 as your multiple, keep that on your personal balance sheet so you can see directionally where you're going over time. So I want to go through this real quick. Factors that affect your proceeds. If I tell you your business is worth $15 million, it's not worth $15 million to you at the closing table, because you're going to have the valuation, you're going to have cash-free, debt-free, which is very important. The cash that's on your balance sheet you keep, your debt is yours and you have to pay it off. So when you think about your personal balance sheet, it's EBITDA times a multiple plus your cash minus your debt. Meaningful reinvestment. Most founder-held businesses, you have to make a reinvestment and show that you're committed to the deal and stay on. Very, very typical. Almost nobody gets a full valuation exit. Escrow, there's a portion of your funds that are going to go in an escrow to protect you against things that come later. And then taxes. A couple other things. Working capital balancer. When you hear somebody say it's a tax-free, debt-free, and you're like, oh, I'm going to run down my inventory and run down my accounts receivable and run up my payables, you just can't do that. But working capital balancers are very tricky to create, and anybody who ever goes through an exit that I work with, I try to get the terms of that negotiated very, very early, way before we get into documents. And then lastly, a seller note, which is sometimes instead of doing a investment, they'll do a seller note, which, as my banking friends note, what are seller notes? They're way down on the stack, and they get the same interest as the guy at the top. Seller notes are terrible for the sellers as far as, being a good loan, but it's what is necessary to get deals done sometimes. So, real quickly, quiz time. And the winner of this quiz gets my best-selling book, Things I Wish I Knew Before I Sold to Private Equity. Many of you have read it. Thank you, Byron. All right, so here's the question. Byron, just going to use you as an example. You and I agree that your business is worth $100 million. And I'm going to give you $50 million at closing, and you still own 55% of the business. Is it a good deal?
Sounds pretty good.
Sounds pretty good. But is it a good deal?
You'll probably say it's not.
Anybody else want to weigh in?
You say 100 million.
Yeah, you're basically getting half of the valuation and proceeds, but you keep over half of the equity.
What type of earnings?
Doesn't matter. I'll cut to the punchline. David?
Not sure what you're going to say.
Let's see. Who wants a? I already gave you a copy. You have one, right? And I know you guys have read it. Here you go, Frank. Enjoy between surf trips.
It's all levered.
Well, it is leverage. You can't evaluate the fairness or value of a transaction if you don't know how much leverage they're putting on it. Because the percentage that you own at the end of the deal is a function of your proceeds, your ownership percentage, and how much leverage they use to get the job done. Grab a glass of water, please. Thanks, bud. I appreciate you, Drew. Yeah, so it's a factor of those three things. So if you know 2 of the 3 numbers, you can't evaluate it. You have to know how much leverage is on there. So I want to show you this as a sample deal. This is my deal. So this is the deal that I did back in 2012. Thanks, Drew. They offered me a $15 million valuation to purchase my company. And they said, what does it take to make this work for you? I said, I want $10 million at closing. I said, I got to take $10 million. You give me 10 million, this is a good deal. Wasn't thinking about the after. I felt like my business was worth more than 5 times EBITDA, so I kicked and screamed to get that other 250, and they gave it to me as a reinvestment. So here I am, I do the deal, proceeds work out like this. I reinvest $4.25 million, put $1 million in escrow. I actually had a very strong cash position. I took all my cash off the balance sheet. And this was back in the era of the Bush era tax cuts, plus I had some retained earnings, so I had some other things working in my favor. So I had about $1.2 million in tax liability, and I did well on my working capital balancer because I killed it the last 2 months, so my accounts receivable went up and I got paid for that. So my sales proceeds were $10 million. Life is good. Now I have a partner and we move forward. So all the things we talked about, the private equity magic, operationally they did. We focused on margin, we focused on staffing, we focused on the product catalog, we built an engineering lab, we opened up a sourcing office in China. We grew this thing like crazy. Over 4 years, we raised the earnings of the company from $3 million to $10 million over 4 years. Never did an add-on acquisition. Opened a shop in Reno so that we could one day hit the West Coast with our products, did some fabrication and assembly out there, expanded our product catalog to include stuff from China, the imported products we were able to sell at good margin. Things were clicking along. We decided to go to market and sell the business. We sell the business, and over that time, we generated $25 million of free cash flow. So the money that the business was making as it was going along ended up hitting our balance sheet, and those ended up being proceeds as well. But here's what's interesting about that deal. When we talk about the leverage and the debt and the ownership percentage, my exit in 2012 was unlevered, which meant they didn't borrow any money to do my acquisition. Their logic was that we were so small, because we were right on the cusp of what was big enough to be a platform acquisition. They said, you're so small that we're going to apply the leverage to the add-on acquisitions, and we're just going to kind of just go full-throated into buying companies. We were up against the tax horizon being 2012 because we knew Obama was going to change the tax law, and he did. So we closed my deal, no leverage. So what does that mean? I had 26% of the equity of the company. They had 74. We sold the company for $103 million. I made 31, they made 88. I had a good day. Do you want to see what keeps me up at night? What if they would put leverage on it? We talk about a leverage accelerating those returns. So if they applied leverage and we think about that ratio, my contributed capital was still $4.25 million. If there was leverage, their contributed capital would be less. My ownership percentage would have been more. If they did 1 times my earnings in leverage, which would have been $3 million, my proceeds go from $31 million to $37 million. Not bad. But nobody does 1 times leverage. They could have done 2 times leverage off their line of credit. I didn't know to ask that. In my mind, my super conservative engineer, like not a finance guy's mind, this was a very, very safe deal because they weren't using debt. The company will be strong, will last forever. But if they had put 2 times leverage on the deal, my proceeds jumped to $47 million. It's a 50% increase in what my proceeds would have been. This is my deal. For them, it would have been less money, but a bigger multiple on return of equity. Because in the first deal, we got like 6.5 times. I mean, this was a fantastic return of equity deal for the PE partners. But for me and my math, that's meaningful. And I didn't know the questions to ask. And for anybody who ever reads my book, there's a whole chapter on leverage in there, and there's a reason for it. Yes, sir?
I got a question, go back a couple slides. I know damn well that my working capital number was way more than yours. They're just buying your AR at that point, right? They just...
Working capital balancer, not working capital. It's funny, I pulled the working capital balancer slide out of this because I knew we'd be tight on time.
Yeah.
So that was the net of the working capital balancer. My working capital was a big number, but we pegged a working capital number on the balancer. And then when it was done, we did a post-closing audit, valued the inventory, because my inventory was $2 million. Valued the inventory, valued the AR, the AP, and went through everything from an equipment standpoint. And then there was an adjustment one way or the other, and I did good on the adjustment.
And that was part of the working capital number.
Correct.
Inventory plus.
It's funny, Carrie, the one slide I pulled out, because I have a whole slide on working capital, but yeah, that's, the working capital is a nightmare, but yes.
Oh yeah, we fought hard.
You probably got screwed on your inventory.
I guarantee you I did.
Yeah, almost everybody does. Almost everybody does.
You can do a full 3-hour presentation on work.
Yeah, you could. Yes, sir.
How would it, if you had gone with one of these leverage opportunities, how would that affected the cash that you got in the first year?
It wouldn't have affected the cash at all. Cash would have been, it would have just affected the percentages afterwards. Yeah, because what happened is that when you think about the percentages here, right? $3 million leverage, which meant, so I got, call it 11.5 pre. Instead of that being 11.5, their contributed equity would have been 8.5. So the numbers would have adjusted down. So just my percentage would have been bigger. And then the first $3.5 million that we made over the time frame, which is in the model that this is all based on, the first $3.5 million that we made would have been used to pay down the leverage. So we would have paid off the leverage as opposed to having the excess cash. So last thing, if they had done 3 times leverage, which 3 times leverage is very, very conservative capital on deals. My last exit was 5 times leverage. But what's interesting about that is they would have never done that because they weren't going to do a minority equity deal. So the whole idea is if we were a 5 times deal, 3 times leverage meant they were a minority partner and they would have never been a minority partner. So that scenario would have never came to fruition. And when I promise you, like the title of the book, like things I wish I knew, this is the #1 thing I wish I knew. I wish I would have known to say, hey man, love the deal, throw a turn or two of leverage on it. Like lever this up just a little bit. I had no idea. I thought what they were doing was good. And maybe if we hit headwinds, it would have been. But this is meaningful. But that's not to say that none of that comes without risk. Anytime you put debt on a business, there's a lender involved, a bank, bankers. And they have what are called covenants. And covenants are their way contractually of measuring the health of the business over time. And as the performance of the business starts to slip a little bit, you blow your covenants. And as you blow your covenants, which mean these statistical measures start to come out of favor with the bank, they get more rights. And the ultimate right is they take the equity, which happens sometimes, which is what happens when somebody files bankruptcy and they call it hands the keys back to the bank. The company is not worth what the debt is on the company, and then the bank ends up owning the company, and it happens all the time. So this is all a way of saying that while I'm sitting here going, man, I wish there was some leverage, leverage isn't always good and doesn't always work out that way, but in my case, that's kind of how it went. So thank you all for sitting through that. We have lunch teeing up. The rest of the day, we're going to have our lunch sponsored by Coastal Investment Company. Greg's the president of Coastal Investment Company, CEO. He's back there quietly just learning. Not as good as your beard. We're going to have lunch hosted by Coastal Investment. Carrie's going to come up, tell us a little bit about Coastal. We're going to learn a little bit about Four Roots Farms. And then Rich is going to teach us about tax strategies so all these business owners can pay less taxes. Yes, sir.
Before you go, let me
Yes,
ask
sir.
one last question. Do you think, given the scenario that's unfolding right now with large private equity and the equity problems, do you think that's going to have any effect on the local, the lower mid-market private?
So the short answer is no. There's tons of dry powder out there and businesses still have value. I mean, you look around this room, there's a lot of businesses that are doing great despite anything that's happening in private credit or you look at tariffs and all of this other friction that's happening. Businesses are still operating, money is still changing hands, businesses still have valuations, there's still buyers. What it does affect is valuations Because what happens is when you think about a leveraged buyout, like for instance, this war in Iran, everybody expected the gas prices to go up. Interest rates have gone up too, so it's affected mortgage prices. Well, if it affects interest rates, it also means that it's going to affect the models that are used on how much leverage can be used on a deal, and it drives down the equity value through driving down the multiple. So I think that whatever the economic conditions are, whether it's a ripping market or tariffs and war and all these other things, operating businesses still have value. The external factors affect the multiple.
And you think the reset of bonus depreciation drives that as well?
Depending on the industry, I think most industries, like my company, the bonus depreciation wouldn't have made a hill of beans difference because of what we did, but I think there are industries that it absolutely drives it. I can tell you that a lot of the coastal stuff that we're doing, a lot of the money that comes in is based on the opportunity to capitalize on bonus depreciation and accelerate that on equipment. Yes, sir?
There's one thing you had on your slide, but you didn't talk about it too much, that I see as a bogey for people a lot of times too, is that earnout.
Oh, yeah.
People don't realize how much risk they're placing on the future performance of a business that they no longer control.
You know, I didn't say it explicitly, but when I'm working with my clients, I always say the money that you get at the closing table has to be enough. Don't count on the earnout, don't count on the seller note, because there's so many factors you can't control on the earnout. I'll just give you a quick little thing on this, and this is the way I think about it. An earnout is the way for you to get the premium multiple. So if you guys are selling your business and you say it's worth 8 times and they say it's worth 6 times, and they say, well, we'll give you the other 2 times if you hit the bogeys, then you can use your performance in the future to get you the premium multiple, where if you miss the bogeys, you don't get the premium multiple. But as you know, they could add additional cost to the business, there's a million things that can go wrong when they start applying their investment thesis.
Particularly in the majority.
Particularly in majority.
You're not pulling the strings of.
And particularly in an add-on. Because they could just flow their overhead expenses to the different companies and say, oh, this is your allocation overhead, and all of a sudden your numbers get killed and none of that was in your model for the earnout, and now go fight it with the lawyers. Yes. I'm sorry, are there any other questions? Well, great. Well, thank you, everyone. We have lunch brought in.
We have a couple more minutes until we're ready for lunch. We're ready? Couple more minutes? All right, one thing I wanted to add, Jason's presentation is typically about 3 hours, and he tried to shrink that down to about an hour and a half. So if you'd like to learn more information, I'm sure Jason would be willing to share it, and he speaks pretty often doing these presentations. I guess I'll do the quick little intro onto Coastal, and then we'll eat, and we'll follow it up with Rich. All right, so my name is Kerry Sobel. Again, I'm the Chief Acquisition Officer at Coastal, and before I tell you about the company, I'm going to tell you a little bit about what I do in my journey with Coastal, because it happened organically, and it's a good kind of picture on how you can get involved with the company if you're interested. Greg, our CEO, is a great buddy of mine, about a 20-year friend, and I had invested with Greg prior to Coastal even in existing. And when Coastal spun up, it spun up very organically. Greg had a very successful career before Coastal. He made a bunch of money and had a couple large liquidity events, and he formed his own little private family office to help him save money in tax and to have the highest and best use of his money in alternative investments. So Greg would start taking positions with some of our sponsors, which I'll talk about in a moment. And he looked around and said, I have a lot of wealthy friends that don't have the same access I do. They don't have the same knowledge about alternative investments. And that's kind of how Coastal was born. And there's several Coastal investors in here. There's really no more than 2 degrees of separation of people that work within the Coastal community, and we like to keep it that way. So I wrote my first check to Coastal in 2021. I invested into an apartment complex. I didn't have a clue in the world what I was investing into, but I believed in Greg. And as I started to understand the world of alternative investments and the access that I had to private markets, I got a little bit more intrigued. And the economics, when you're closer to the value source that actually produces an asset, you're going to make more money. About 2023, I had an exit of my own company, and I used one of Coastal's tax tools with which Rich is going to illustrate for you, and I saved a ton of money that I would have given to the IRS. I rolled that money right back into a Coastal investment, and it's kind of the full cycle of what we do for people that work with us. If we can keep money in your guys' lives, you're happy. If we can provide you good returns in your investments, you're happy. And in 23, Greg asked me to come on board and be a part of the team because we were missing a service line, which is mergers and acquisitions, business brokerage, and helping our clients exit the businesses that they're in a tax efficient and strategic way. So Coastal at its core is a private investment firm, and our mission is to provide successful people access to and advice about institutional real estate and venture capital investment opportunities. The key there is access, and the key there is institutional. Several of you probably own your own real estate. I had several of my own real estate properties, and Greg kept making fun of me and saying, toilets, termites, and trash. Why do you want to keep dealing with that? One day I went to one of my investment properties, and my tenants had a pig living in my house, an actual swine. So I had to evict my tenants, and it was at that moment that I'm like, I do not want to do any of my own public real estate investments, and I got a little bit deeper involved with Coastal. But the access that we provide is really the key ingredient with Coastal, and we started out mostly doing real estate investment, only institutional grade, and these are some of the asset classes that we work with. Multifamily, self-storage facilities. Anybody familiar with the build-for-rent community asset class? So essentially think of a multifamily apartment complex, but instead of that, it is horizontal, it's single-family homes. The younger generations don't care about home ownership as much. Some of them can't afford it. They still want the backyard, white picket fence, let their dog and kids run around. The economics are a lot better on a single-family home that's not actually selling. So there's innovative asset classes like that we try to stay ahead of the curve, and as we learn about these and test them out ourselves, we open them up to our Coastal clients, some of the other asset classes. This is a picture of us and our sponsors' co-owned portfolio. It's not really cohesive, but it kind of gives you a general idea on some of our footprint. We invest in blue-collar businesses in the Sun Belt. The Sun Belt is typically in-migration areas, such as the Carolinas, Florida, Georgia, Texas, Arizona. We're not going to invest in public or primary markets like LA, New York City, and Miami. We'll look at Charlotte, we'll look at Orlando, we'll look at Sarasota, we'll look at anything else that's in that general area. Through Coastal Ventures, we also offer ability to participate in private equity transactions that are typically growth equity in middle to late stage companies, sometimes early stage companies. If you look at the bottom right, to name a few, we invested in a defense contracting company. It's actually drone defense. I think we took a $20 million position in this company. They already had a couple $100 million in contracts with the US Army, the US Air Force, so it was a well-established company. They had some great intellectual property that we believed in, and they're one of 3 companies in line to get the program of record with the Department of Defense. If that happens, our investors and ourselves, we're going to be very happy. Also, financial and banking, we just did 25 of a $50 million growth stage investment into a company called Barwick Bank. This is kind of similar to what Jason was talking about with a roll-up. Of course, I could talk forever about our investment opportunities, but these are just a few of them that we have on platform right now. What is most important to learn about Coastal is we are the money vehicle. We bring the capital to the table, and we give the money to groups that do a thing, and they do their thing very well. On the real estate side, these are a few of our sponsors. The sponsor on the right is Sealy. If you look at the slide here, Sealy was established in 1946, it's a very long time ago. Sealy is famous for building last mile industrial. Is anybody familiar with that? Okay, so think of Amazon warehouse, right? Amazon's pretty big. Amazon has probably the biggest footprint of last mile industrial across the United States. But as e-commerce continues to grow, think about Target, think about Walmart, think about every other retailer. The last mile of an industrial location brings that product to your door. So it's going from one industrial warehouse to another. So as the footprint in e-commerce grows, so does last mile industrial. This company's been doing it since 1946. And I know this from the top of my head, they have a 22.5% IRR since the company's inception. That means every year they've returned their investors 22.5%. So if they've done this since 1946, when we select a sponsor like Sealy to work with, we're betting that they're going to do it one more time. It's a pretty safe bet. So we do a lot of vetting on all of the companies that we work with. Madison Capital Group is probably our closest sponsor. They have a lot of different asset classes that they work on. We'll talk about those in a moment. And just like we partner with real estate sponsors, it's the same thing with venture funds. So the group to the left is Anchor Capital. The group Apeiris down there that you saw was the drone defense company that I was talking about. That's one of our investments. And Equipment Share, which Rich is going to touch on in a little bit as well. We also are involved in some platform investments. So through our partnership with Madison Capital Group, these are platforms that are our theory is really to buy and sell. We don't really hold. However, when you have a platform investment, you also do grow the brand and try to get more enterprise value where you can sell larger amounts of units for a larger price point. Everybody's familiar with Blackstone, right? Has anybody heard of a B-REIT before, or a REIT? A real estate investment trust is pretty much a group of institutional assets that are put together, and you can go on public markets and you can buy a piece of a B-REIT. I have it in my portfolio, and historically is one of the most profitable and safest REITs you could buy. I think it spits off about 8% a year. There's no difference in what you're buying in a public market B-REIT than what we are offering to our investors, except you're closer to the source. So if we manufacture a piece of real estate, like in these platform investments, they then get sold to the Goldman Sachs of the world and your financial advisor that you work with, and then you buy it on a public market in a retail grade. So that's really the access and the channels that we're playing in. It's just a food chain. These are platform investments. Ghost Stored, I think, has 220 locations across the United States and continuing to grow. Link's Car Wash, I remember when the idea came up about 3 years ago. We now have 40-something active locations. 40 active locations, 10 more in development, and we're going to get up to 200 and then sell the whole portfolio to somebody like Blackstone, BlackRock, KKR. It's just a food chain. We also offer a lot of advisory services to our clients. We call them, our clients have champagne problems, first world problems, and our goal is to provide any value that we can within our subject matter experts within our organization. My space is M&A brokerage and advisory. And I want to talk to you quickly about Coastal Consulting, which is essentially our advisory firm that offers M&A strategy. And this is from somebody who is ready to exit now, somebody who's ready to exit in 6 months, 24 months, 36 months, or somebody who is not ready to exit anytime soon, but they would like to talk to us about some growth consulting. We're all entrepreneurs ourselves. We've grown businesses, we've sold businesses, we've had them fail. Our goal is to help our clients, both prospective and current Coastal clients, successfully navigate a transaction through our work in the M&A space. That's it. I think lunch is ready now, so if you guys want to get up and eat, we'll give you a couple minutes before we start telling you how you can save some money on tax.